we're trying to just quantify the amount of froth in the system. Historically, it's like, okay, well, if we have 100% annualized funding rates, it's clear we're getting to that froth. But okay, you're just telling me here that the froth could actually be in different vectors, which is interesting because you're having actually more shorts on the perp side of things. That might skew it a little bit. So yeah, like how do you measure and quantify just the froth in this new era of convergence that you just described?
Well, it's a good point. Look, we in the venture fund we invested in. I should mention Finality also has a venture fund. I run the hedge fund. We have a venture fund that does pre-seed, seed, Series A. We invested in Athena early on, so we obviously that basis trade is a big flow dynamic for suppressing to some degree because of the flows how much basis will blow out, right? And you'll see that too with on the TradFi futures, whether it's CME, a lot of these flows, if the basis is positive, they'll short the future, go into the ETF, and that's why you can see such big ETF flows for Ethereum or others. How do you measure froth? I think funding rates and basis are certainly one of them, right? That's something I always want to watch over like a medium term cycle, right? When they hit 50 and they're blowing out to 70 like they historically have, it usually marks a local top. But you can't really, maybe you want to lighten risk there and trim, but that's certainly one component. I think another measure of froth is, when you see some of the more retail dominated names start to really have, I would say more blow off top type, medium term blow off top moments, whether it's the Ripples, the Stellars, right? The non-institutionally owned names, you can get a sense there. But I think, and people have pointed to DATs as froth in this cycle. And I think, DATs are one interesting component because, you could really just bucket those in with the, like an IPO wave, right? Whether there's demand for IPOs in a hot market. And you saw that with SPACs, et cetera. But I think, to some degree there's froth in that segment, right? But that froth actually is probably healthier froth for the underlying market than any froth because, as you launch all these DATs, right, the price impact for the underlying is probably still very positive, right? Because now you have these public vehicles, even if they trade down, right? To be idealistic about whether DAT's a bad investment or good, you have to really talk in specifics, right? Is it a good investment for the person in the primary? Are you going to make money in the secondary market? Is it going to cause some underlying structural issues for flows, like deleveraging and selling during a bear market for the underlying ecosystem? But are they also going to create good underlying metrics of adoption, right? They're going to build businesses on top of the chain. So there's a lot of different nuances to how you think about what's frothy and what's good or bad for the different parts of the market, and particularly for what investments you own.
Mm-hmm. Yeah. Let's double click a little further into this DAT thing, digital asset treasury companies. So obviously we had this discussion on that panel a couple months ago. We had Tom Lee there, which was awesome. Literally the day before he launched BitMine. Very awesome. Obviously, there's been a lot of success there. So, okay, I feel like a lot of the main points have been, kind of, it's starting to be like beating a dead horse. But one of them that's sort of unique that I'm curious on your take on is, it feels to me like when you look at each of these companies in isolation as like an individual company, you're like, okay, these are not that levered, especially the ones that are just, doing the at the markets and they're not even in the debt markets yet. Like it's really not that levered compared to some things out there. But then it's like, okay, well, when you combine 200 of them, do you have to view that differently? That it's sort of like on its own, it's not that risky. But when you look at the confluence of them all together, does that in aggregate increase the potential systemic risk? And how do you measure that? So yeah, why don't we use that as a jumping off point? Curious on your take on all that.
Well, I think there's, probably 100 billion of assets underlying NAV behind all the Bitcoin, ETH, and Sol DATs. And most of that obviously is in Bitcoin and MicroStrategy. Who is, in terms of the leverage of the entire space, maybe they have maybe they have 10% or 15%, probably less than about that 15% leverage debt to equity on it. And I don't think MicroStrategy represents a leverage risk. And I don't think really the broader universe actually has room to lever up. So I think you could actually put more leverage. I'm not saying take it to 50% or 40, but you could put another 10 billion, 20 billion of leverage on the entire DAT market cap. I don't think any of the ETH DATs actually have any leverage, any of the large ones at least. And so there's actually room there for those to put on leverage. And the the quality or the type of leverage is also what depends for what risk you're going to create. And obviously, there's risk to the equity holder because you now have someone senior to the capital structure. So leverage inherently does create downside risk on the cap structure. But I think most digital asset investors are probably more concerned with the leverage that equates back to the ecosystem, which is going to cause someone to default, have to sell, or liquidate their assets. I think that stage of leverage is actually not really an issue at this point. There's a lot of things where you can look at, when the term structure of the existing credit come due. A lot of it doesn't come due for many years. A lot of it's very what's called covenant light, meaning they have a lot of flexibility from their debt holders as to how they can manage things like collateral coverage, like interest payments, and whether they default or not. I think there's not really a lot of risk in the default of most of the debts at this stage. But I think that maybe the risk to the underlying maybe comes more from if the NAVs, you get a bear market. Look, I was head of research at Grayscale. I've lived through both the GBTC ARB trade from nearly the beginning and through the cycle of it being, obviously, like many folks, converted to an ETF. And I think the bigger risk for the underlying is not so much a leverage liquidation. It's really at this point, right? That could change, right? People can get very aggressive at different stages of the cycle. But at this point, I think it's more just NAVs fall below. You get people that are tired of the strategy. They say, I'm just going to sell my spot. And then you have somewhat of a prisoner's dilemma where those fragmented guys start to sell. But you know what? At that stage, maybe you do have someone like a sailor come in as a buyer of last resort if it's accretive to him to buy them up. So there's a lot of dynamics that have to come into play for thinking about this market.